Good morning. How are we?
Good.
Good.
Oh, calm down, would you? See the energy and the excitement.
I'm still just distracted by the under the sea vibes behind you.
Yes, for the listeners at home, when we bought this park, it had this dodgy brick wall that I didn't like, so I commissioned a local artist to put a big mural on it, and it looks like I'm in Finding Nemo.
Or a daycare centre.
Yeah.
It looks impressive. It's a pretty good setup.
And what have you guys been up to? Our Adelaidean team are sitting in jumpers, so it must be cold down there. It's already 28 here, and it's 10 to 8 in the morning, by the way, with like 90% humidity.
Yeah, it's 32 right now up in Cairns.
Yeah. I think high of 18 today, Jack?
Yeah, something like that. But it is improving. Like yesterday, it didn't have a jumper on, which was like the first time in a very long time.
Wow.
High of 16 today. Tomorrow, 18 Friday, 22 Saturday, Sunday, that down to 15.
Almost at the point where you can unplug the electric blanket, Jack.
I actually don't have it on today, so that's an improvement.
Well, there was a certain irony that when I went to my room last night and the air conditioner's broken, and they were like, "You didn't approve the CapEx budget in time."
They deliberately put you in that room.
I think so. They say that they didn't.
Oh, what a monster stroke. Well played.
But I have a feeling I'm being taught some lessons.
Love it.
And you guys, in my absence yesterday, have been doing an awesome job getting our deal out. For those listening at home, we've just launched Squizify for sophisticated investors, and that's a really exciting one. Ash and Jack and Aaron, thank you for all the great work there.
Oh, that was Ash and Jack. And great to see the engagement from the syndicate and investors already.
Yeah, it's been really good. Exciting to get my first deal out and start chatting to investors.
Well, should we get into it? We got
Let's
a bit
do
of a limited runway today. I thought we'd actually start with just a recap of something we discussed in a few episodes ago, which was around Eucalyptus. They had launched a product called Compound, which was a longevity play targeted at men, costing $1,000 a month. But what they've actually done now is they've sent a message out to current and past members on Friday saying that it was in need of an overhaul. It was temporarily frozen as a result. In this article in Capital Brief, it says they were quoted as saying, "There's a tension between launching early and delivering a high bar with a very manual experience, whilst also rebuilding the underlying operating model. So we've decided to pause operations by the end of the year so we can set up a relaunch in H2 2025. Some members told Capital Brief earlier this year that the concierge service and follow-through had been lacking for a product that had been repeatedly marketed as high touch. Thoughts?
We did chat about this one, and I think we did talk about, I don't want to say we predicted anything, but we did talk about the challenges. But Jack, do you remember what revenue they were doing at the time?
No, so I think what we spoke about was the revenue if they converted the waiting list. So they had a really
waiting list of 4,000.
Yeah,
that's right.
Yeah, I think it's just a really hard play to play in. I think it's a growing industry. I've got a couple of friends who are also growing and building a startup in the similar space, and it's very hard to get right, and it's very hard to build the traction and maintain the traction. And something that they've also shared with me is similar to what it looks like has happened with Compound. But as soon as you have a beta out and you're testing it, and then you want to build your next version, it's very hard to continue to build while you have that platform going. They've also had to do a similar thing where they've paused all engagement with their customers to do the rebuild and then re-onboard them as well. So not sure if this is something particular to this ecosystem, but they've had a similar challenge.
Like we were talking about before, though, it's good that they called this and took this action, right? Rather than just forging ahead and throwing a whole heap of capital into something that wasn't working. They've obviously seen some data that has said, well, we need to pause and revisit.
Yeah, I think it's great that they've done that, especially given they're a public profile company and they were going to end up in the media. Clearly, taking hard decisions is difficult, but I think a lot of entrepreneurs fall into a trap of not willing to make those decisions sometimes. So I think that's good. And the other reflection is that it does highlight, it doesn't matter how long you've been going, how much capital you've raised, how much success you've had in other products. you can't give birth to an adult. Like new products, new markets, new services have to go through a predictable life cycle of challenges, and infancy companies and little toddler companies inevitably need a lot of management. Sometimes things don't go right. And so I think founders and investors can actually become a little bit more proactive in understanding that and actually building in a bit more time and fat into the pipeline and not having expectations that we're going to have this worked out. So just a reminder. Anything you're in, Jack?
I've got a lot of tickets on Tim Doyle, the founder of Eucalyptus. So I'm excited to see what they come back with.
I can just imagine Jack's future office with tickets. Good thing. So for the founders you don't rate, what do you have for that? Voodoo dolls.
I thought there'd be a rugby analogy. They'll be in a sin bin or something.
Oh, I was more thinking your go to jail card. Yeah. Wait to Monopoly star.
Well, let's get into some current news that came up in Capital Brief. There was an article. The headline is "The Curious Case of Scale-Up Advisory Backdoor ASX Listing via Defunct Lolly Shop." They had me at Lolly Shop. I thought there's got to be something in here, but the Lolly Shop was a previously listed company that's fallen into hard times, and now Scale-Up Partners has started a process to backdoor list. And for listeners, the way backdoor listing works essentially is you have the defunct company that's generally sitting there with either a little bit of cash or not much at all. An entity comes along and says, hey, why don't we merge essentially? And what happens is they get issued generally somewhere between 90 and 98% of the issued capital. And the existing shareholders of the listed shell end up with 2 to 5% or whatever it is. And then the shareholders of the company being acquired effectively become the majority, and that's how they take it. That's how they take it over. And they call it a backdoor because you don't have to go through all of the more expensive aspects of a straight IPO, but you do then have to go and raise some capital. And so in this article, it said, when Scale-Up Partners unveiled plans in May to list on the Australian Stock Exchange, it wasn't shy about its ambition, declaring that it exists to empower visionary tech founders to transform their ideas into great businesses. 4 months on, the float of the Scale-Up advisory firm via the reverse merger has appeared to hit significant regulatory obstacles, albeit ones that the CEO, Caroline Breeze, insists it will overcome. Last week, the Australian Securities and Investments Commission issued 2 interim stop orders on Candy Club over the deal's prospectus and its target market determination, a regulatory requirement for laying out who a financial product is appropriate for. ASIC stop orders prevented Candy Club from offering or issuing securities for 21 days. But Breeze described the situation as a storm in the teacup and said that the stop orders never applied to Scale Air and Candy Club as they weren't yet trading. Now, at 5:30 this morning when I was re-looking at the notes, it came out yesterday that ASIC has now taken away that stop order. So the CEO was right. It seems to have been a storm in the teacup. But the article did say that ASIC's intervention wasn't the first time concerns have been raised about the transaction. On the 11th of April, ASX notified Candy Club that it was not satisfied with the documents lodged regarding the proposed acquisition, citing concerns about Scalar's business model and historical cash reserves. The article also has, in a press release sent to Capital Brief earlier this year, Scale claims to have delivered 298% total return from its inception in 2020 to date, and has 27 startup investments investing in 8 a year. The company's business model involves sourcing revenue from multiple streams, including returns from its portfolio, gains from business exits, fees for conducting fractional products and advisory services, and memberships for its events and organizations, and fees for capital raising. So I thought there's just a couple of things here without getting into the detail of their business model too much, but where I think it's interesting is that founders that have ideas have multiple places to go to raise capital. There are individuals and entities that just raise capital and are there to support you. Then there's the sort of service provider end of the market. They charge you to raise capital. They then charge you for services. They charge you to be a director. They charge and charge. And I get a little bit nervous with that, but would be interesting to see your perceptions.
I totally agree with you on that. Just one little segue, and then I'll come back to that point. A request for a future Sharts is the end success of backdoor listings versus IPOs. I'm curious if there's a pattern there or a trend.
Having been one of those, I would be a little bit triggered putting that together, but Aaron, however, I will do so.
One of my early angel investments, they did a backdoor listing, and the process was pretty straightforward, but then they ended up collapsing before the restraint on shareholders lifted, so walked away with nothing. That's why I was curious. But yeah, coming back to your point, Don, I think this murky water, like there's consultants that charge for these types of capital raising services, and then you have all sorts of models around venture studios and everything else. But I think it gets murky when investors start charging fees for service. And we've seen this in different ways. Some venture capital firms do HR talent recruitment services as a fee for service. Some charge for their directorships, which they've actually mandated as part of their investment term sheet that they need to be on the board, but then also charge a fee for being on the board. I've seen in some term sheets where the VC actually charges an ongoing annual fee just for the management of the investment. They're charging the portfolio company for that, as well as double dipping with the investors on a management fee. And one of our shareholders was having a big rant about one of the funds he's in that's doing that double dipping, charging portfolio companies as well as charging investors. So I think I don't know, my gut reaction is I think it causes a misalignment of behavioral incentive. And I think, yes, you have to be completely transparent with that on both sides. But for me, if you're investing, I think it's different to the other service providers and consultants. And I think you should structure things differently.
They're all really good points, Aaron. The thing I'd be keen to chat about is listed environments. So startups and early stage businesses obviously being listed comes with a whole host of additional compliance, reporting, all of that. And our hypotheses would have been it's not a place where startups want to play, particularly if they're trying to scale, grow, find product market fit, hack things together to just test their hypotheses in the market. Yeah, and this is a newer model that I haven't really been exposed to before, so I'd be keen to chat that through.
I think the majority of companies that list shouldn't list. And the problem is, I say that from a difficult position, having listed a company that shouldn't have listed, because all of the things played out that you just described there, Ash, and that you actually have to have this underlying strength. If you don't need future capital, it's no problem. Listed environments, no problem. One of my biggest shareholders at a certain point when we were getting into a little bit of a pickle was like, if investors don't like a company, just they'll sell their shares. Don't worry about it. The problem is you do need to start worrying about it if you need money. And so companies that list that then need ongoing capital, it's a brutal environment and you can just get absolutely wiped out. With this instance here, what I find intriguing is there's so many examples that demonstrate that essentially fund managers, now these guys aren't a pure play fund manager, but they're going to have unlisted assets. And I'd love to talk about what their prospectus says about their valuation methodology, but you're going to have a part of your balance sheet that is an unlisted asset. And they just, time and time again, we find companies that do that just have difficulty on the listed environment. At the bigger end of town, you come under all sorts of attack for the way you do valuations. And then if you're big enough, short selling becomes a problem. Again, short selling is not a problem if you don't need cash, right? If someone wants to go short, doesn't really matter. As WiseTech has demonstrated, like if your underlying business just keeps pushing out cash, it doesn't matter what the media says. It doesn't matter what the shorts say. The business will go on. It's only if you actually need cash are you actually in a bit of a pickle. And I remember when I first listed, in my mind, when I was going to go and meet all the investors, we'd have like these engaging conversations and they'd be interested and we'd create these relationships. And it's like, no, at the institutional end, you've literally got like 30 minutes. They're playing on their phone half the time. They're not, you're a rounding error in the portfolio. And if you miss a number or you miss something else, that's it, you're out. And they brutally sell you down. And then the problem for us is we were partly like a trust-based thing. And so during the lockouts, when insiders couldn't buy shares, we then missed some numbers, we disappointed, and we had some shareholders start selling down, but none of the insiders could step in. So our share price came down. My competitors then started going to my major clients going, oh, there's something wrong here. Have you seen their share price? Down 30%. They're in a whole lot of trouble. And that then sowed the seeds of doubt that the reason why I wanted to list was strength and to give confidence and all of these things. And so suddenly I was now having conversation with clients and they're saying, actually, we think we've got key supplier risk here. So we actually need to divide up your contract. So I've then gone from a situation that was a lot stronger pre-listed, and now it's being used against me. And we lost a whole lot of contracts. And in the listed environment, if you can't get that support, it's a spiral down. You just end up spiraling down, and you crash into the ground. And it's not a good space. But the problem is, from an entrepreneurial point of view, it's where people want to end up. And anybody that says to me, I want to take my company public, I say, well, okay, let's go and find a couch and lie down and work out all of the ego and trauma-related issues that are driving you to want to be on the listed environment. And then they tell me to fuck off, and off we go. So
totally agree with you, though. How many of them eventually come back around though and say, "Oh my God, I wish I'd listened"?
It's a difficult environment. That's why, with the way the capital markets are now, with the way secondaries are available, like they weren't available back in my day when things were black and white, I just think you'd be crazy to go and do it unless the listing is actually an exit, which it never is for in reality. You've got long lockouts. Unless you can get out, I just don't know why you'd want to do it. That was a long rant. I apologize. These are risky things to let me just start perfectly.
No, whenever it is a trauma point. No, but your points are all spot on.
I mean, one of the things I do want to raise, because I then went into their prospectus early this morning, there are actually two in my personal portfolio companies that I did do some fee for service swaps for. They wanted some on 1K surf lakes, they wanted some large scale stuff that was well and truly out of the brief, and they were willing to pay. And I was like, no, at the next round, I'm happy to take discounted shares. I'm not totally against it. It's just, it's not a core part of my business model. I don't rely on it. I don't have to report it to anyone. One of the intriguing things here in their prospectus, it's got portfolio company valuation methodology. Scalar will review the progress of each portfolio company on a regular basis. This includes a formal valuation review twice a year as part of the company's preparation of half-yearly and annual statements. Now, it goes on to effectively say, if they've done a raise in the last 12 months, that's the carrying value. I don't have a problem with that. Like, I don't think you need to sweat the small stuff. If the majority of capitals come from outside investors, like that to me is the value. But it says, if there has not been a complete capital raise in the last 12 months, the Scalar Investment Committee, now who is the Scalar Investment Committee? It is the CEO, the CFO, and the co-founding and other partners. So it's the company itself. They will apply a number of key quantitative and qualitative measures that it considers important in determining the valuation of a company. After thorough discussion by the committee, so them, on all factors, this valuation is then applied to Scalar's equity holding, determining the value Scalar will record for the company. Just makes me nervous that every 6 months, the company itself, in a listed environment that has all sorts of incentives, is going to be valuing its own book. I get nervous at that.
No, absolutely. Like we use the standard, the Australian Investment Council, which has adopted the International Private Equity and VC valuation standard, last round method. It's interesting even that they say within the last 12 months, like when you think of the average time between rounds for most ventures. But I totally agree with you, Don. Like I think like reading through the composition of the committee that actually determines that valuation, there's no independence And
The
that's
main
very
thing is
risky.
it's disclosed. Like it's disclosed in the prospectus. If you're an investor in them, like just understand it. The only thing for them is if they grow, and hopefully they do, and they add value and all those kinds of things, we have just seen so many companies get totally screwed by, especially on the short side or negative press around the valuations. And this approach here, I'd just be so nervous about. But anyway, it ain't me. Jack, what are your views of companies or investors charging for all services?
Oh, the actual VC investors, I don't think it's the right thing to do, especially just because you look at these resource constrained businesses, the last thing they need is a cost base for a director, which really is just an early stage advisor, right? Like I'm very pro, you want the right incentive and structure and the ownership mentality. And when you get the alignment right from the VC, like we're buying into the company at X Val and we're helping to partner to grow this to a really large venture, but taking a fee in those early days isn't that alignment.
If I think to the incubators, I think a lot of the incubators started off with the right intent, but then you've signed a lease and you've got staff and then some marginal startup ideas that, but actually they're going to come in and they're going to pay. And before you know it, it just descends into madness because actually you've got to keep your landlord paid, you've got to keep your staff paid, and the incentives, in my experience, drove a huge drop in quality, a huge drop in value. And have a look at how many of these accelerators and startup hubs that ended up closing because ultimately they weren't able to pump out anything of quality.
Yeah, definitely agree with you on that one. You reminded me, Plug and Play in Silicon Valley, one of their early tenants, so that's a co-working space, one of their early tenants was eBay, and eBay couldn't afford to pay the rent, so took a small equity stake. That equity stake ended up being worth something like $1 billion. And it's ended up funding the Plug and Play model phenomenally. But yeah, look, as a founder, you're always grappling this balancing cash flow versus equity. But I agree with you, Jack. Like when an investor's coming in, there should be alignment of the behavioral incentive. There should be alignment in where you're trying to grow and the use of capital to grow. And I get nervous when there's, I just get nervous.
Nervousness shouldn't be viewed as anything other than that. We're often wrong and we have our own incentives and maybe we're just jealous. Maybe our business model's dumb and actually we should just start charging for a whole lot of stuff because our life would be a shitload easier, wouldn't it? Having more cash coming in.
I would sleep at night. Maybe I'm just a total freaking idiot. Yep.
I wouldn't be sitting in 3-star caravan parks with other things. So when we took this over, the last review from before it was closed down by the liquidator was that this was a really great place to shoot meth.
Oh, we're that low.
Okay. Once I read that, I was like,
Don's in.
Where do we go? But anyway, after we've blown a few $1 million tidying it up. Anyway, look, buyer beware, do your research. And at the end of the day, sometimes people can't get capital from certain places and you just got to go where you can go. Now, speaking of capital, there was an article in Capital Brief by Bronwyn Clune that was called Funding Fog. It says the lines between equity, secondary and debt are blurring, sparking a debate on capital disclosure and transparency in the ecosystem. Where this sort of came from was that Safety Culture did their last announcement and they just said they'd raised X. But actually they'd raised part in primary, part in secondary. Simon Thompson then went on LinkedIn and I think quite rightly pointed out that the media probably could do a better job at explaining these things. And the company, it's really the company, to be honest, but the media being savvy enough to ask the questions. And Bronwyn's article, I think, is quite thoughtful because it splits up primary equity, secondary equity, and debt. And what are your views?
Oh, I think we touched on this, I think it was last week, Don, as well, with some of my views where I think having more opportunities to raise capital in different avenues is great for our startups, but it would just be nice to have transparency, both from an investor lens, but also from a founder lens, to if you are looking to raise, understanding what is working in the market right now, because if the market's sending signals that people aren't interested in equity at the moment and that it's better off to go to a debt round, as a founder, you'd rather know that and have signal from the market versus waste all this time and energy trying to raise equity and then you're left with debt. And so I think it's great to see these different avenues. Chatting to Tractor just yesterday, and I think these are all great avenues of being able to find funding, but transparency. And I think both from the company itself and the media digging into the details a little bit more would be great to see. And I think, as Chris from Crop Through Ventures said, it's really hard for them to be able to report clearly and transparently on this because they're having to now go much deeper and actually validate these numbers with someone either on the investor side or on the business side of what was actually true.
Yeah, I totally agree with you. And like, there's a company we know well that a couple of times now has gone to raise capital, which they've said there'll be some secondaries, but it's like been pulling teeth to try and get clarity on how much of that will be secondaries, how much will be going to growth capital, who's selling the shares, like, and even getting insight into their last round about, okay, how much went towards secondary. Like, and it for me, that's a red flag of
kills trust.
Kills trust, absolutely kills trust. Versus being transparent and actually seeing it as a positive to talk about the fact that we've been able to give some of our early investors some liquidity. And so I think the key lesson for me, with all of this with founders is be transparent with your shareholders. They're in the boat rowing with you, or hopefully they are. And there's a lot of value that comes from that in terms of the trust that gets built. But this cloudiness, murkiness in the water, we're seeing it. We're seeing it in all different things. Versus, I've got to say, like current deal that we have out, Daniel's been incredibly transparent about the quantity that may go to secondaries and who that would be from. So just be transparent.
And it's changed. I mean, I'm just thinking now back to the first article about Scale Air. It's 2024. Effectively, next week will be 10 years since my thing went public. And back then, any conversation about me taking anything off was met with just a lot of negativity, and I didn't, and that was part of the problem. And my view on it is that I don't want founders totally stressed out and unable to have the brain space because they can't meet expectations at home and school fees and have a reasonable holiday and pay a mortgage. Now, it can't go the other pendulum when we're not beer, Skittles, corporate jets and helicopters at the space that we're at. So there's a balance. Secondary, I think, has become far more acceptable. And in terms of announcing it, secondary is a lot harder. And I think debt's a lot harder. Like if a company's been able to pull off secondary, i.e. investors are saying, you know what, I'm allowing my capital to go to non-productive places, i.e. outside of the company. Like to me, that's a big news story. That means that you have pulled off something great. And then on the debt side, in 2021, 2022, a whole lot of companies were given debt that they shouldn't. And I think we're about to see these new venture debt companies get into a bit of shit with portfolio that should never have gotten debt, and they're going to be holding companies that they don't know what to do with. But even that's hard. Like, why wouldn't you say, okay, we've just raised 10 million, 3 million is primary, $1 million of secondary, and however many in debt? Like, just be transparent. And I think it's a bloody great news story because it means your company is actually at a phase where you can have multiple types of debt. Now, from the journalist's point of view, I would just be interrogating and just asking what types of capital was this?
I agree it should be transparent, but like the reason it should be transparent is it makes the data more accurate. But when we speak about like having empathy for the founders, because they're looking at the headlines thinking all the funding is going to 1% to 2% of the startups. Like if I think of that in the VC's perspective, I couldn't care less if X VC raises 500 million and 50% of that is for venture debt, 50% of that is for early stage. Like we're heads down building. I honestly could not care less who is raising in the market and how much they're raising and how that's divvied up. So I just Yeah, like I want it to be transparent, but I also don't want to waste too much airtime talking about something that really doesn't affect us because we're heads down building. And I think the founders should have the same mentality.
Yeah, just the other point I was going to make was that if you are a founder and you're able to mentally contemplate all three avenues and have all three avenues to reach your round, I think that also shows a sophistication level of you as a founder, where you actually understand the market to a greater level. You're able to communicate to these different avenues of raising capital, as each will need a different pitch, different data. And so being able to tailor that, I think, shows and demonstrates a level of maturity and sophistication.
That's a good point, Ash. Really good point.
Yeah. Well, one of the reasons we're raising equity and raising debt is so we can burn, baby, burn. And there was a post by Airtree, you got to burn to earn. But how much is too much? And this is always a big conversation. And so I really appreciate this post. The post says, the efficiency of a startup's growth reveals a lot about overall health of the startup. Our favorite metric for assessing this is the burn multiple. This metric measures how much cash the startup is burning to generate each incremental dollar of ARR. The lower the burn multiple, the less the startup has to spend to grow. In other words, its growth is more efficient. And there's a full article that I'll put in the show notes, but there's a little table and it says burn multiple benchmarks between 0 to 10 million, the 25th percentile, so that's bad, the burn multiple is 3.8. So it takes like $3.80 for every $1 of ARR. The 50th, so the median, is 1.6. And the 75th percentile, the good, is 1.1. And I think that aligns with what when we're doing DD or when we're working with companies, if we're slipping below 1 to 1, we start to get nervous. Now, interestingly, it then changes between 10 and 25, like the 75th percentile drops to 0.8, 25 to 75, it drops to 0.5, and 75 and above, you're expected just to be able to produce. And that would make sense, right? As you get more mature, you should be able to use your cash flow and profitability to grow. But I think this is important because especially in follow-on rounds and more in a capital tight environment, investors are saying, well, hang on, you raised 5 million last time. Your ARR is up 1.5 million. I'm not going to contribute to that. And then the founders, we've learned all this and this is what we're going to do differently. And we're going to do this and we're going to do that. And then you end up in a gap situation because you can't actually prove that it is going to magically improve.
It's great to see the data being published. And I think for founders to be aware of this data and measure themselves against it. And yeah, particularly, like Don, your statement is so true at this stage, particularly that we look at like pre-Series A, Series A. And it was good on the back of this, Jack looked at our current deal that's going out to the syndicate, which is sitting nicely within the 75th percentile. And that incorporates some hardware in our HAS model in that as well. So, but yeah, I think the entire concept of capital efficiency in the current market in particular is incredibly important. And yet we hear founders, it's always interesting to me the stories the founder tells himself about why their numbers are different. And this concept of, like, for example, we have to do a land grab. And then when you actually look at their gross margins and everything else, the unit economics don't stand up. But the belief that at some point this will convert, whereas, like we know with scale and other things, what tends to happen is that those things don't play true. And if anything, they get squeezed even more on margins and everything else as contracts increase in size. So I think it's really important for founders to actually benchmark themselves here.
Yeah, I think it's important for founders to understand the burn multiple. So that's comparing the net new ARR divided by the burn. Oh, sorry, the other way around, comparing the burn by the net new ARR. And it's a really catch-all for your efficiency. So whether or not your sales and marketing engine is actually worth scaling. Because if it's not worth, like if the economics don't align, there's no point scaling it. And if they don't align, and there's a good reason for it, like there is a land grab opportunity, for example, Uber, like then you've got the narrative there to then tell the investors, this is why the burn multiple is X. And if there's a plausible reason, that's fine. But it's just having an understanding of where you sit and the reason for it.
Actually, just on that, was this data specifically B2B? It wasn't, was it? It was just generic across. It'd be interesting to compare B2C versus B2B.
Well, Sydney, you set me a homework task earlier. Aaron, I'm going to set you that homework task.
All right, I'll take that on.
That would be good. Just in the interest of time, I'll push the death as a service to next week. There was just a couple of.
Oh, I like that one. Okay.
Okay, well, let's do it. Now, the key is being capital efficient means you can get through to the point where you can run on your own cash flows. And if you don't do that, companies die. Now, in a terrible segue, I'm now going to move to an article that's about death as a service. Platform Wild has just raised $3 million as the media company Seven signs on. I really like this one for a couple of reasons. One, it's good to see them raising. Two, I think there's a couple of things to discuss, because what happens with people like Seven is that they, a bit like our first thing, is their contribution is actually media to get it out. And in my experience, it never actually yields the results they would hope. But it's not just that. They've got a really great group of investors, and the company, founded in 2019 and launched in 2020, Wild is a death as a service software solution dealing with issues such as wills, probate, power of attorney, prepaid funerals, services, and cremation, with the goal of making end-of-life planning simple, affordable, and recently, just in my role in a couple of things, having dealt with a couple of very messy estates because entrepreneurs did not do the planning properly, it then fucks the family left behind. I can't underscore that enough. And so from that point of view, it piqued my attention because this is such a big area. I only got my first will last year, so I lecture people. I'm potentially one of these people that is in this case. So that's why I see this and go, sign me up, because I'm terrible.
Well, speaking from experience here, so earlier this year, I actually went through this whole process and I wanted to use a online will platform. I think I tried 5 and none of them worked, because unless you are extremely simple and you want to split up your assets by percentage to people, and you don't want to go, I want this to go here and I want this to go here, it's very difficult to find a platform that can handle that, let alone if you have a company in a trust, then it gets even more complicated. And so after spending 2 weeks trying to use an online platform, I ended up having to go to a lawyer and just getting it done. But the other thing to note here, which I didn't know and is in particular an Australian issue, is that wills in Australia are only legally binding if they have been signed with a wet pen, and the wet pen is the same signed by every single person who signs that will. And that will must be the original form when taken to the lawyers or all of those processions at the end. So if you have on these online platforms, it's like, yep, sign it and put it on the internet. I was like, great. I never have to worry about where the will is. It's just going to be online. I can give my executor all the information. No, they actually need the physical copy. So then you need to have either want to take the responsibility of looking after that. I did not want to do that, versus paying a lawyer. They put it in their fireproof vault. So I think this is a great initiative, and I would love someone to call in, write in, send us a DM in LinkedIn, email, if they can find one that fixes this. But Don, I think your estate would probably be a little too complex for something like this, but it is a great initiative. And you know, my partner, for instance, he can do this because it's very like black and white, traditional career. Assets are just like his property. But if you have company trust, things, moving parts, which my guess is most entrepreneurial people do, I think a lawyer is a safer bet. Just my 2 cents on this.
Yeah.
Working out who's going to get my medals.
They should go on the tribe estate. We'll have them signed.
Oh, they need to be donated to a museum, Dom. Oh, far out. No, I totally agree with you, Ash. Like we post wedding, Maren and I went and got our wills updated, and the complication of blended family with exes and understanding who can contest wills and it got super complicated. And then family trusts and things that we'd forgotten about. And then you guys know, mum had a mild stroke last week and just been going through all of this over the weekend with mum. And it's so complicated and by no means easy. And you'd rather deal with these things not in those moments, but plan in advance. But yet it's something that we all kick the can down the road, like you said, Don. Like you put it off. So critically important. I think, Don, your segue was awesome because when you said death as a service, I thought of the correlation to VC. I think we could describe VCs as death as a service companies. But good to see Seven West Media investing. Like I've co-invested with them on some stuff, and yeah, it's good to see them still active in the ecosystem too.
It doesn't happen often, but the consequences when it does happen is problematic. And Jack, you'll have to be updating yours with a new one coming in.
Yeah. I haven't even thought about it, to be honest, but this has prompted me.
As soon as you buy a property, gotta have one.
Yeah.
I was going to say the trophy from this year's grand final, but then I remembered there isn't one, so we don't need to. Well, I hope that team goes really well. We'll keep an eye on it. We actually had a listener question come in from Mitchell Hughes, and he wrote in asking how SPVs, so special purpose vehicles, and follow-ons work from a fund manager and LP's perspective, specifically VC firms accepting investment for the management company to boost op funds, how that works, why it would happen, how does the carry get handled, how an investment committee works at different firms, external versus internal, what it means for founders, and then typical SAFE terms at angel versus pre-seed and occurrences of SAFE versus price rounds from a founder and investor perspective. Great questions.
Really good questions. So diving into the SPV, so special purpose vehicle, we have a syndication model. We spin up a new unit trust for each investment. Now, we do that on the back of the advice that we received. There are different models for this in the syndication world. Some operate one trust that essentially issues a different class of units for each investment. But for us, a single purpose vehicle, a special purpose vehicle as a single entity for each investment we make, because we have different investors coming in who become the unit holders. It's a nice, easy vehicle. We're basically compartmentalizing one investment in one portfolio company, the risk associated with that, the financial management of that, all in one entity. And when we have a liquidation event like we just did with Vendor Panel, we return the assets to or the funds from the proceeds of the sale to unit holders, and then that entity is wound up. So for us, it works really well. There is overhead, obviously, with that, but it keeps it nice, clear, and simple for investors coming in. It's easier to manage in some ways. It does mean we have multiple trusts, though, to manage.
What about then how ICs work? I assume you've been Googling this.
So I've seen all different versions of investment committees in different funds and syndicates. Ours, so our core investment team is on the investment committee, and then we bring in externals. And so for us, it's important to have externals on the investment committee. The purpose of the investment committee is a final sign-off. In the context of a syndicate, we get them to look at the company itself. We get them to look at the deal terms. We get them to look at our investment process. And also included in that is our documentation around it that we're going to present to a syndicate. The reason we bring in independence, it's fresh eyes that see the opportunity, like particularly, for example, with our most recent deal. This is a founder that we have been working with for some time. You get very close to the deal, and having an external set of eyes just to challenge and question and poke and prod and bring their own perspective is really valuable. Different investment committees might have more independent on their board. Sometimes they bring in people who have non-voting rights just to give perspective. Some investment committees operate on a 2/3 majority basis. We operate on a unanimous decision, like everyone in the investment team has to agree to approve the investment. So they all operate differently. For venture capital funds, where unlike us, they're not a syndication, they've got captive funds, they've got LPs. That process is typically well documented. The composition of the IC is well documented, but there is variance in how they each operate.
And something just to add there is only our investment team presents to the IC. So some funds may actually get the founder in front of the partners or the GPs of the fund or the IC. But at Tribe, we champion the deal ourselves and then write the memo and then present that to the IC.
The other question in there is C firms accepting investment for the management company to boost ops funding. So I wouldn't say this is common, but it seems to be becoming, well, we're seeing it more often. But we raised capital into our management company to fund our ops. The question that was being asked here is, why would that happen? And I guess implied in that is, what's the upside for the shareholders coming into a management company? So for us, we structure our carry policy where there's a return of a portion of our carry and it's documented back to shareholders. So for shareholders in our management company, they essentially have the upside of profits, like realized profits. Not all management companies operate in that way. It's unlikely Tribe would ever be acquired. Maybe some of our future funds could be acquired, but really the return of capital for investors coming in shareholders is really around that portion of carry. It's not common, but we've seen it with a couple of the others, like Aussie Angels raise capital around their model. I think for us, we didn't raise a captive fund to start with. And so for us, going to syndication first means our operating model, it'll take some time to get to cash flow positive. And so having those shareholders on board has been really valuable.
And Aaron, do you just want to touch on just the operating model a little bit more? Like, I don't think many people realize the business model of a VC.
There's a business model? Yeah, so
I thought that's the reason why we were going to change our corporate structure to charity status.
Yeah, so the business model typically is a 2 and 20 model where the fund manager essentially charges a management fee of 2% of funds under management per year, and then has 20% of realized profits above a certain performance hurdle. So for us, we charge, syndication is a little bit different. Normally there's an upfront management fee. Ours is 8%. Others vary up to 10 or even 12%. And that's once off. And then our performance fee, should a deal do well and return capital to investors, we earn a carry of 20% of realized profits above a performance hurdle. The other revenue stream for us is things like our trade missions or our scale-up missions, taking groups over to the US and UK. But that's really it. And it's a tough model because for founders who might not understand this, until you get to about 50 or 60 mil in funds under management, you're not washing your own face. And you have to, the other challenge, particularly in the current climate, is you have to earn the right to raise a fund of that size. And so for us, syndication is an opportunity to validate our thesis, validate our operational cadence, and build out our systems and processes, earn the trust and earn the right to raise a first captive fund. And it's fair to say in the current market, we are raising, or will soon be raising, our first captive fund, but it's going to be fund 2 before we pass that break-even point.
One of my friends who's a founder, a founder of a VC fund called Spice Capital. She did a recent podcast and it was everything you've wanted to ask about VC, but too scared to ask. And I thought it was really good. She's a bit spicy like me, hence the Spice Capital name, but she just didn't hold any punches and just said it how it is.
Yeah, she'd actually be good to get on the podcast, like as a guest.
I'm catching up with her later this week.
Get her on. And then the other core thing is we've adopted the line, too stupid to quit.
Got to cockroach it.
Oh, it's a bad image.
Well, with my canvas skills that I'm trying to develop, I'm going to try and impose all of our faces on a cockroach. How's that?
No. Your mic blocked done from Canva, Aaron.
Well, if Canva keeps upping their prices the way they do, cutting back another user probably will have a material impact on our P&L. So
Spicy weird. All right, shall we do some Sharts? Because I've got to jump back on an excavator shortly. Okay, let me go share. I shouldn't say that. There's no trees are being harmed in my trip here. So this is the unemployment rate seasonally adjusted for Australia. And as we can see, we're starting to tick up which is a bit of a problem for the RBA because there's a lot of calls for rate hikes. But going to the airport yesterday, and I've never seen the place so busy. So interest rates have not deadened consumer spending. For the listeners at home, unemployment has went from about 3%, it's now 4.2%. But with these kinds of charts, a body in motion tends to stay in motion. And once something starts to happen, it continues. This next chart is the rate expectations of Australia versus the US. And I don't understand it because it has the US dropping, which makes sense because they had a rate cut already. But this idea that Australia is going to have this long, slow move of interest rates down with the other economic data that keeps coming out, I don't see it. But not only too stupid to quit, too stupid to forecast. So don't take any of that as financial advice, which will be highlighted by this next chart because this is the kind of stuff I anchor on. This is the Rolex market index. So this tracks the average price of secondhand Rolexes going back to 2017. So you can see that it started at 12,000, started to rise a bit, then just massive COVID peak, got just over 30,000, and now we're back to 21,000. So those with rollies on their arms are feeling the pinch. So maybe that's enough to see interest rates come back.
Can we do Chanel handbags next, Don?
Yeah, probably. It's probably all the same. Chanel handbags and...
They're still appreciating, don't worry.
Well, I actually forgot to pack properly. And on the way back, I'm going to stop in a Kmart and get a new shirt because I stink.
I thought you were going to say new handbag, Don.
I don't know.
I didn't know where that was going.
We know to Kmart. Okay. It's an interesting correlation in your brain then.
Yeah. Where do you want? I don't...
Kmart.
Kmart. Kmart. I love it, Jack.
Glad you didn't say Tarjay.
That's right. Yeah. Tarjay. So this is a chart from the markets. Saudi Arabia to build the world's tallest tower, reaching 1 kilometer high. But what this person's done is gone and plotted all of the world's tallest towers being built and market crashes. And when we build a world's tallest tower, that is the precursor to a market crash. I guess it's to do with huge amounts of money floating around. But yeah, and then speaking of market crashes and bear markets, if you were born in 1920, you lived through 12 bear markets by the time you were 40. If you were born in 1930, you lived through 14 bear markets by the time you were 40. 1940, 8 bear markets. 50, 7. 1960, 6. If you were born in 1970, 5. If you were born in 1984, born in 1992, and born in 2002. So what's actually happening as the financial system gets more sophisticated, more integrated, bear markets are actually becoming a much less thing, which makes sense, but it doesn't stop a lot of people looking back to all the historical patterns and trying to forecast it back. We live in an exponential world, right? So I think just the sheer financialization of our economy and the integration of markets means that it's just up and to the right.
How much experience do you have, Don?
He's had 14 crashes.
Let's have.
And that's just his personal life.
So Ash, I'm not actually 65. I know I look 65. Just to confirm that's a throwback to one of our portfolio company who will remain nameless, who asked me how old I was, and when I told them, it was like, fuck, bullshit, you're at least 50. I'm like,
he asked the CID to prove it.
Yeah, I had to get my license out. This is in London. I had to get my license out and prove to him I'm the token poor genetic person. The rest of you hold your weight.
No, do you agree, Don? You've been Benjamin Buttoning it recently. You were versed age.
Well, recently I've this, but there are some points in a certain type of light, especially on Teams, because it doesn't do the thing. You just go like, hang on, what happened here? How did this happen? But when there are drawdowns, this next chart, it can be a long wait. It says these charts tell you about the actual path of bear market, setting aside that the extreme outliers of the 1930s. As an investor, you'll see numerous 10 to 20% drawdowns, but sometimes you might have to wait years. And so this is in months. And so getting back from some of the bear markets was like 30 months 100 months, 50 months, 60 months. So it can take a while. But going back to spurious correlations, this is the MSCI World Stock Market Index. This takes all of the world stock markets, but also the live average weight of a turkey. And the correlation. So all I'm saying is I think we should start tracking the live weights of turkeys, because if they start to drop, I'm concerned. I'm concerned about stock markets. But yes, for the listeners at home, there's a very strong correlation between the rise of the world stock markets and the average live weight of a live turkey.
I'm already trying to unpack. Yeah. Someone's actually pulled that data together. But I'm trying to unpack the causality. Are people buying turkeys earlier during certain parts of the market
It's not causality. Correlation doesn't mean causation. It's charts. It's not charts. If you want stuff that's of value, just tell me. But at the moment, I'm looking to charts.
That is such a good one.
So this is S&P 500 stocks with consecutive years of 10% sales growth. I thought this was quite interesting because actually there's only one company out of a cohort that has survived 10 years of 10% sales growth. For the listeners at home, it just falls off. Companies can make 1, 2, 3 years of 10% sales growth. Now, keep in mind, this is the S&P 500. So these are really big companies. In our world, if you're doing 10% sales growth, just shut it down and go and start something else. But it's just interesting that like the maximum in a cohort was 200 that could do it for the first year. Then that drops to like 140. And in medians, by year 3, it's dropped to 41, year 4, 27, year 5, 16. After 6 years, only 10 companies, all the way through to after 10 years. So it just shows that it's really hard to stay at the top of your game.
It also highlights like companies like Technology One, like what they've achieved is just phenomenal.
Yeah. They are only shin. And I found this one. This is true, isn't it? My charts and graphs are, so this is a 4-quadrant. Up the top, easy to comprehend. Down the bottom, hard to comprehend. On the right, fascinating. On the left, boring. My perception, easy to comprehend and fascinating, top right. The reality, however, is hard to comprehend and boring, is what I think everyone else.
No comment.
It's the green highlight around the charts this week for me.
There's a what, sorry?
The green border around the charts.
Yeah, I'm not sure how that's happened. Just maybe Canva. That's where I'm at in my journey, being able to put a border around pictures.
Oh, we're definitely starting that account down, Aaron.
Yeah. I just love the 1980s color scheme.
What are we looking forward to? Yes.
Yes.
Are you excited?
Yeah. And jumping on some calls with some investors.
Yeah.
That's very exciting.
And so you're in Cairns as well, Aaron?
Yeah. So left Rocky yesterday. And up here, we have to empty the house up here.
And you're in Palm Cove?
In Palm Cove, yeah. So we're in the
I'm
house.
I'll see if I can leave early and come say hello.
Let's do it.
I've done with the backpack.
Yeah.
The backpackers bus going up to Mission Beach from Mission Beach.
Yeah, I'll see if I can. Yeah, okay, cool.
Yeah, that'd be awesome.
Not that I want to highlight the dysfunction of communication between us of where we all are, but it's good.
Well, it all got messed up with
No, I'm joking.
Yeah. What about you, Ash? What are you looking forward to?
It's Wizardite. It's number one focus.
That's right. You did say that. Yeah, that's where my brain goes. Yeah.
Yeah.
Jack?
Yeah, I'm the same. I'm glad we got the memo on the pitch deck over the line. It's been good fun working with Ash. And I suppose what am I doing this weekend? I've got a mate coming down from Queensland. So I'm showing him around Adelaide. And it's the AFL Grand Final. So it's quite a big event in SA.
Yeah.
Nice.
Yeah. And it's like no Melbourne teams in the grand final. How good.
Yeah. Jack, you're quite experienced at watching grand finals from the sidelines. So,
You guys are never going to let this die.
mate, we've got to have something.
Yeah, fellow. How'd your concreting go?
Yeah, it was good. So the boys that I was working with had never heard of ChatGPT. So on Smoko, I got them to all download it and they were writing poems and they could not believe it. They were like crashing up.
Jack, you are spreading technological.
I love it.
All right.
I hope you told them to turn the training off. I'm not sure I want some ones training the GCT model with Paul.
It scrapes the web anyway.
Well,
There once was a concreter from Dubbo who... No, I won't. All right. Good day.
Hey guys.